For more on what the Fed may or may not do, we're joined by Daniil Manaenkov, the head of U.S. forecasting at RSQE Square at the University of Michigan. Daniil, good to see you again. Last time we spoke, things were much more, I think, calmer and more reasonable. We were just talking about inflation. It was like, should we do it or should we not do it? But now things are so complicated. We have the bank stuff that you just heard me talking to William about, and then we have this inflation stuff, and then we have like a little bit of underlying panic, if you will, because I heard if they raise rates, the markets don't like it. If they don't raise rates, markets may not like that either. So I don't know what's going to make anybody happy now.
Right, and thanks for having me. And that's a good description of what the Fed is looking at. They're basically between a rock and a hard place, and it's all ultimately tied together. So at the moment, at least the last few hours today, it seems like the panic may have been subsiding. So in that kind of environment, the Fed is going to be looking at that the long-term rates have declined and that may be too low, and they will be probably raising rates tomorrow.
If this was your decision, so let's just cut to the chase. If this was your decision, would you raise it or not? What would you do?
I would probably raise still, because inflation. So the Fed has two objectives, well, really three, but the third one is making sure that long-term rates are at reasonable levels is still far from being binding. So they're looking at inflation. It's still a problem. The labor market is pretty tight, and it's not clear to me that there is stress in the financial sector outside of some regional banks. So assuming that they think that they'll be able to handle the stress, there's no reason to start cutting rates at this point.
But maybe not cut rate. Look, maybe not cut rates. But if you're saying that we don't see enough stress in the system, when there is enough stress in the system, it's going to be far too late. Why not prevent additional stress in the system by taking a break? I understand that inflation is an issue, but quite honestly, we've raised a lot in the last 12 months. If you just lay off for one cycle, which is really another 5 or 6 weeks, it's not really going to impact inflation in the near term at all. You know that. So why not give investors and give consumers maybe just a few weeks to kind of catch their breath a little bit?
Right. So the Fed lately has been paying very, very close attention to what the markets actually expect. And if you look at the Fed funds futures, I think they're pricing in like 80% probability of a hike tomorrow. So pausing rates tomorrow will be a surprise, and raising 25 basis points is basically the path of least resistance, at least as it looks right now.
And do you think the market would, well, obviously, look, it's not just a rate hike, it's also the words that the Fed chairman is going to say, the statement, and then obviously the press meeting afterwards. And a lot of people say, well, if he does raise rates, then they might be really soft. They might even hint potentially at rate cuts down the road, which is, and my concern is we're expecting this perfect Goldilocks scenario where he raises rates but then says really dovish things down the road. It just doesn't make any sense to me. Like, I want to be healthy but then eat steak and really fatty foods. None of this makes sense. Isn't the market going to be very disappointed if they don't get what they want?
Right. We've had a few meetings like that where a statement said one thing and then Chair Powell went on, talked, and markets basically maybe cherry-picked some of the things that they liked and ran with it, only to discover a few weeks later that maybe that wasn't what the Fed meant. So I'm sure there's going to be some volatility. I will be personally looking to hear what the Fed wants to say about the state of the banking system. And I hope they're sounding confident and I don't know.
Do you think the banking system, I guess number one, how would they react? And do you think they're in a position where that if there's another rate hike, that they would just take it in stride and go, well, you know, it's all planned, lots of credibility, everybody's happy, or are we looking for another shoe to drop?
So at the moment, long-term rates are quite a bit lower when the SVB crisis started just unfolding. So I doubt that the long-term rates are going to move dramatically tomorrow. I think the markets at the moment are pricing in several cuts late this year, and a hike right now is probably not going to do that much. So basically, it will be important to watch what the Fed says about what they think, whether the economy is resilient or not. And I'm personally not seeing signs of stress in like credit spreads or anything that would signal that the economy is about to, I don't know, hit the wall. If you, I don't know, look at some of the real-time estimates of what's happening to the first quarter GDP, it's actually pointing like 3% growth. And that may be looking a little bit further back, but there are very few signs of stress in the economy besides what is happening in the financial markets. And we know financial markets are volatile.
Daniil, I appreciate your time. We all hope that you're right, and I guess we're going to find out in about a little less than 24 hours. Thank you very much.
Thanks for having me.